Forex traders everywhere are often intrigued by how George Soros and his hedge fund Quantum Fund broke the Bank of England after his famous shorting of the British pound. Here is how he did it. Hi, welcome to the channel. If you are new, please consider subscribing so that you don't miss future videos. Remember to hit the like button just to motivate us to continue making these videos. By the way, if you are interested in making money online via trading etc., visit the links in the description box below. Let's get into today's video. So let's talk about how Soros made $1.5 billion in just a single month by betting the British pound and several other European currencies were priced too richly against the German Deutsche Mark. Most people forget that it is not just Soros who made a lot of money on what has come to be known as Black Wednesday. Other people who went in for the ride with him cashed in big time. Paul Tudor Jones of Jones Investments made $250 million, while Bruce Kovner of Caxton Corporation rang the register to the tune of $300 million. Leading U.S. banks with big foreign exchange operations, especially Citicorp, J.P. Morgan, Chemical Banking, Bankers Trust, Chase Manhattan, First Chicago and Bank America also netted around $800 million, but no one made more than Soros, who cleared $1.5 billion. Besides making him an instant billionaire, the score made Soros a trading legend and assets under his firm's management jumped to $7 billion, from $3.3 billion by mid-October 1992, and to $11 billion by the end of 1993. Soros' bet benefited from the insular nature of the Bank of England in the early 1990s. He and others had bet that the British pound and other weaker European currencies were overpriced against Germany's Deutsche Mark. They bet that the politicians and the central banks could not no longer maintain the artificially high exchange rates in the interest of European unity. Europe had an exchange rate mechanism, ERM, which had been set up in 1979 by the then members of the European Economic Community to keep the various European currencies relatively stable against one another. Relatively narrow fixed trading ranges were established within which the prices of 11 European currencies were supposed to fluctuate. But the system could work only if the various countries coordinated their economic policies. If one nation had, say, higher inflation than another, there would be great strain on the system. Differences in interest rates also would strain the system. When differences in interest rates and inflation rates among the 11 got out of line, the central banks had to intervene to buy and thus support the weakening currency against speculators and currency hedgers. In former times, powerful central banks could usually frustrate speculators by simply buying massive amounts of the weaker currency and flooding the market with the stronger currency. However, while the exchange rates the central banks were defending made political sense for the European leaders committed to the European community, they no longer made any economic sense. Soros and the others who won big that day realized that they could make a lot of money if the market overwhelmed the banks through one variation or another of a basic trading technique, going short on the weakest currencies. Shorting a currency can be done in a number of ways. The simplest is simply to borrow money, say, Italian lira, and convert the borrowed money into, say, Deutsche Marks at the fixed rates. Then you wait for the lira to drop sharply against the DM, buy in the now cheaper lira to repay your debt and pocket a lot of extra Deutsche Marks. In September, the lira was trading at 765 lire to the mark. 4 weeks later it took 980 lire to buy a single DM. A speculator who had performed this operation would have made a profit equal to 28% of the borrowed sum. But his profit would have been much more than 28%. Speculators with substantial credit lines like Soros can borrow on a margin of 5% and get 20-to-1 leverage. That means you can borrow $1 billion for speculation by putting up just $50 million in cash. The result, instead of having made 28% on your lira bet, you would have made 560% or $280 million. After German reunification in 1989, in Soros' view, it was only a matter of time before the European exchange rate mechanism came unglued. By 1992, it was clear to just about everyone that some European currencies, including the British pound and Italian lira, were fundamentally overvalued in relation to stronger ones such as the Deutsche Mark and the French franc. As Britain and Italy struggled to make their currencies attractive, they were forced to maintain high interest rates to attract foreign investment dollars. But this crimped their ability to stimulate their sagging economies. While the British and Italians tried to deal with weak economies, Germany embarked on a policy of trying to restrain its own economy, overstimulated by the spending on Eastern Germany. Not just George Soros, other players also started betting against the central banks and the ERM. Foreign exchange traders at investment banks like Goldman Sachs are constantly aware of what is happening in the international money markets. When large institutions, mutual funds and multinational corporations that do massive currency hedging to protect their profits started selling the weaker European currencies in September, the traders immediately picked up on the jump in volume they were handling for their customers. They could easily estimate just how great the selling pressure was and how much the central banks would have to spend to prop up those currencies. Then, the banks and investment houses got into the game for their own accounts. It was obvious, for instance, that the Bank of England wouldn't be able to support the pound successfully, so the banks started to use their own capital to heavily sell the currency. We mentioned that Soros played a complex game. Soros expected the following: the breakdown of the ERM, and a substantial realignment of European currencies, a dramatic drop in European interest rates, a decline for European stock markets. So, rather than simply shorting the weak currencies, he also placed simultaneous bets on interest rates and securities markets that would be affected by the currency realignments. In carrying out this operation, Soros and his aides short the sterling to the tune of about $7 billion, bought the mark to the tune of $6 billion and, to a lesser extent, bought the French franc. As a parallel play, they bought as much as $500 million worth of British stocks, even while they were shorting sterling, figuring that equities often rise after a currency devalues. Soros also went long German and French bonds, while shorting those countries' equities. Soros' reasoning on the French and German markets was that upward valuation was bad for equities, but was good for bonds, because it would lead to lower interest rates. After the lira was devalued and the Germans lowered rates slightly, Soros saw that Helmut Schlesinger, president of the Bundesbank, was openly showing that Germany's central bank would not defend the British pound as well. Because of his strong credit, Soros was able to maintain all his positions with just $1 billion in collateral. He was margined to the eyebrows, but he wasn't really gambling. All his instincts told him that he was betting with odds overwhelmingly in his favor. On the morning of September 15, the currency trades started massively selling the British pound. The financial laws required the central bank to accept each transaction against the pounds. The Bank of England found a way to avoid any contract issued outside the working hours and coined a plan to try to defend the British pound the next day. In the early morning of September 16, at 8:30 a.m., the bank executed 2 orders of £300 million, but the currency investors kept shorting the pound. At 10:30 a.m., the government announced a base interest rate hike from 10% to 12% to bait speculators to stop and start buying pounds. When the interest rate goes up, the price of money is supposed to raise consequently because money is now more expensive to buy from the central bank. Unfortunately, speculators saw it as a sign of weakness and kept selling the pound. Sir John Major, who was Prime Minister, was forced to announce another hike in the early afternoon, this time up to 15%, which was interpreted by the markets as a sign of desperation. Interest rates are used by central banks to keep the value of money in check. So interest rates don't change often, let alone in 2 massive spikes during the same day. At 7 p.m. that day, Norman Lamont, the Chancellor of the Exchequer, announced Britain's withdrawal from the ERM and accepted defeat as the British government could no longer continue trying to buy as many pounds. The day came to be known as Black Wednesday, and the day George Soros broke the Bank of England. Soros's short position against the British pound made him a cool $1.5 billion in a single day. That's how it happened. Like this video, leave your comments in the comments section below, subscribe for future videos, see you in the next video.